How are you? My name is Mr. Ndengwa. Once again, I'm pleased to meet you. Today I'm going to be presenting in the subject of accounting for our O-levels Igcse accounting syllabus code 0452. So today I've decided to pick up a topic from non-current assets accounts, disposals, as well as the provision for depreciation account. So I'm going to be explaining on those aspects. So with me here I have a question which I actually picked from November 2021, variant 22. I'm sure that was number 5 of that particular exam session. So the question read, Simon has a business selling office stationery. On 1 January 2019, you owned 2 delivery vehicles which had been purchased on 1 January 2018. Delivery vehicle A had cost 30,000 and delivery vehicle B had cost 25,000. Simon uses straight line method for depreciating motor vehicles at a rate of 20% per annum on cost for each part of the year the delivered vehicle is owned. On 31 March 2020, delivered vehicle B was sold and a check for 10,350 was received. Delivered vehicle A was still in use at the end of 2020. Okay, so what I want you to know is that each time such type of questions come, they may require you to come up with a non-current asset account. Like in this case, we have a delivered vehicles account that they want us to do. And they may also want you to do the provision for depreciation account and the disposals account. So I'm going to first explain how we do the delivered vehicles account. Remember, the delivered vehicles account is a type of a ledger account that is used to track our non-current assets. So the rule is each time we purchase a non-current asset, what do? We actually debit our non-current asset account with the cost of the non-current asset. The same way, if we dispose of a non-current asset, we also have to credit our non-current asset account with the cost of that particular non-current asset. Like in this case, we are being told that when Simon started a business, he actually owned 2 delivery vehicles. The other one was actually costing how much? 30,000, and the other one was costing 25,000. So it means that as for 2019, 1 January, we had a balance BD of 55,000 in value of his non-current assets. Where are we getting the 55,000? We're getting it from 25,000 plus the 30,000. So in other words, on the debit side of our delivered vehicles account, we have a balance brought down of 55,000. Okay? Did he purchase any other non-current asset? Delivered vehicle A at a cost of 30,000, delivered vehicle B at a cost of 25,000. Simon uses straight line method for depreciating motor vehicles at a rate of 20% per annum. We are not being told of any other non-current asset, which is a delivered vehicle in this case that was purchased. If there was any, we're simply supposed to actually debit again our delivered vehicles account. But in this case, we don't have any purchase that actually occurred. Instead, we are being told that on 31 March 2020, delivered vehicle B was sold, okay, and a check for 10,350 was received, and delivered vehicle A was still in use at the end of 2020. So what we need to take care of now is the one that was sold, because it can't remain in our non-current asset account if we have sold it. So we have to clear it off from our books to show that we no longer own that particular motor vehicle. And how do we do that? We do that by crediting the delivered vehicles account. So we're going to go here and then we put it in. When was it sold? It was sold on 31 March. So 2020 March 31. Okay, we call that disposal. So we disposed it. How much was it in terms of its cost? It costed us what? 25,000. So we put the 25,000 here. One mistake that many students make is the mistake of recording the disposal at the value that we received. No, we don't do that. We actually credit our delivered vehicles account at the cost of the motor vehicle or the delivered vehicle, not the amount we received. That's why you see here we didn't put 10,350, we put 25,000 because we record it at cost. So we credit it on 31 March 2020 disposal, 25 what? Thousand. Which means that, so here we have 55,000, and then here we have 55,000. So the balance CD is at the end of the year, which is basically December 31, isn't it? December 31. Balance CD, the balancing figure here is how much? 55 minus 25, which gives us 30,000, isn't it? This balance CD now is the value of delivered vehicle that we are left with after disposing of that one. So it means that as at 2021, January 1, we now have BAU BD of how much? 30,000. So that's now the value of the delivered vehicles that we now have at the beginning of the what? Of the year 2021. So what are we saying here? The tip is with non-current assets account, okay? It can be a delivered vehicles account, it can be a machinery account, whatever it is. Each time we buy a non-current asset, we debit the non-current asset account with the cost of that particular what? Non-current asset. And if we dispose it, we credit, right? The non-current asset account with the cost of that particular non-current asset that we have sold. Okay? Which means that at the end of the year, we should be able to tell how much of our non-current assets are we left with. Like in this case, we started with a balance of 55,000. We sold another one that was costing 25,000, which means that at the end of the year, we are left with how much? 30,000, the difference, isn't it? 30,000. So our balance CD then becomes our balance BTS at the beginning of the year. That is quite easy. So that's the non-current asset account. So we'd like to look at another section, which is the provision for depreciation account.